Now we're going to move on to the cash flows from investing activities section. So a lot of the investing activities, we can just look at changes in our related asset accounts. So remember, investing activities section is long-term assets. Okay. We might also have some information on our income statement about any gains or losses that we might have had in the sale of assets. We have this information about our purchases and our sales. So we have a $65,000 debit entries for marketable securities and $44,000 in credit entries representing ones that are sold. We show on the income statement that we have a $4,000 loss. Then we need to look at what were our proceeds from cash. So what were the cash transactions? So we have that we had purchases of securities of $65,000. We have proceeds from sale of $40,000. Then we're going to look at our notes receivable account and see any changes that we have in our notes receivable account. So we have new loans made during the year. We have then collections that we received from them, and then in the interest received, we put that in operating activities. So we're only going to look at the loans portion. So we have loans made to borrowers. Those are our notes receivable of $17,000. I'm going to put parentheses around so you can see better what our cash outflows were compared to our cash inflows. And we had collections on loans. So these are money we received for our notes receivable. This is all information that we can get from the changes in the accounts and that additional information that we had on previous slides. We're also going to look at cash paid to acquire plant assets. So it tells us that we purchased plant assets during the year for $200,000. We paid $160,000 in cash, and we took out a note payable for $40,000. The cash payment of $160,000 is only included in the statement of cash flows. So we would just have cash paid to acquire assets. Of $160,000. Then we also see that we sold an asset. So we have credit entries totaling $44,000 in the year. That's a book value of a plant asset we sold during the year, but the income statement shows that we sold those at a gain of $31,000. So we have the book value plus the gain to get any proceeds that we earn from the sale of plant assets. So if we add those together, we received $75,000 from that sale of plant assets, the book value plus the amount of the gain. So we see our review of investing activities. When we add all these together, our net cash flows from investing activities is a negative $115,000. Put parentheses around the 160 because that's an outflow also. It is not uncommon for this portion of the statement of cash flows to have a negative amount. That's because we know that property, plant, and equipment costs a lot of money, and paying cash out for new equipment can be a very large amount out. We're very rarely going to receive cash in on sales that's equivalent to the amount of new purchases made. Then we'll talk about the cash flows from the financing section. So remember, the financing section includes our long-term liabilities, any short-term notes payable, and our equity section. So when we're looking at the balance sheet, we're looking at that amount. So these are like selling bonds, paying off notes payable, paying dividends, receiving or selling stock. So we have some information about short-term borrowing, and we also have information about other notes payables. But we do want to make sure that we include those short-term notes payable in the financing section and not in the operating activities section. So we have information that we received cash by issuing bonds payable of $100,000, and we issued stock for $50,000. So we have capital stock and additional paid in capital. We also paid dividends, and we paid amounts in short-term debts. So we paid cash dividends of $40,000. So this is our financing activities. We have proceeds from short-term borrowing that we received $45,000 in cash by taking out a short-term loan. We paid out $55,000 to settle our short-term debts. We issued bonds of $100,000. We sold stock, and we paid a $40,000 cash dividend. If it had been a stock split or a stock dividend, that would not appear on the statement of cash flows. So the statement of cash flows only shows things that are affecting our cash account. We have net cash flows from financing activities of $100,000. When we put all of those together, we have what is the net increase or decrease in our cash account. So if we add up, we had a positive $50,000 from operating activities, a positive $100,000 from financing activities, and then a negative $115,000 in our investing activities. That gives us a net increase in cash of $35,000. That explains why we have a $35,000 difference in our cash account from one year to the next. That was the direct method for preparing the statement of cash flows. So FASB and US GAAP allow for companies to choose whether or not they want to use the direct or the indirect method. Government entities have to use the direct method. They don't get a choice, but publicly traded companies get a choice. 90% of publicly traded companies use the indirect method and not the direct method. And we'll talk about how to do the indirect method in a little bit. So if we use the direct method, we might have to add an additional reporting requirement. So the difference between the direct method and the indirect method is only in the operating activities section. The investing section and the financing section are exactly the same between the two methods. If we use the direct method, we also have to show the results using the indirect method. So this is one of the reasons that a lot of companies just show the indirect method, so they don't have to prepare two statement of cash flows to meet these requirements. This is a summary slide of those different changes that we made. So when we're looking at our cash receipts, so from sales or from customers, And whether we add or subtract or decreases or increases, this is just a really good reference to have available when you are creating statement of cash flows.